We've all made mistakes when it comes to investing, but so many of those mistakes are avoidable. In today's video, I'm going to walk you through 3 common mistakes I see people make so that you can know where to avoid these along the road. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. So when it comes to successful investing, as much as it's about doing the right thing, it's also about avoiding doing the wrong thing. Now, these wrong things, they're oftentimes the tempting things or the things that seem like the common thing to do. But if we can learn where to avoid these pitfalls, your odds of success are going to be far, far greater. So there's 3 things I want to walk you through today, 3 common mistakes I see beginner investors making so you can avoid these in your situation. So the number 1 example I see that so many people get wrong is they assume that a good company must mean it's a good stock. Now, I'm not saying that's entirely false, but it's only part of the picture. When people are only looking for a great company and avoiding the underlying fundamentals or ignoring the underlying fundamentals of is it overvalued or undervalued or anywhere in between, they're only getting one side of the picture. Now, this is tough because for so long, the best companies were also the best stocks. If you look back over the past decade plus, you see companies like Apple and Netflix and Tesla and Google and Microsoft, wonderful companies, all growing like crazy, all household names. They all have products and services that we all use on an annual and daily basis. But when you looked at them, they weren't just great companies, their stocks were outperforming everything else. So as an investor, it became very obvious or seemingly obvious, oh, if I want a great stock, I just have to pick a great company. Well, that's what everyone thought until 2022. 2022 was a great reminder that being a great company is only one part of the equation, but if we're not also factoring in the valuation into something overvalued or undervalued, we're not seeing the whole picture. Because when 2022 came along, here's how some of those stocks performed. Tesla was down 65%. Facebook or Meta was down 64%. Amazon down 50%. Google down 39%. Apple down 27%. All great companies, all doing great things, they all underperformed the S&P 500, many of them by a very significant margin. So what this starts to tell us is it's not enough just to have a great company, it's easy for those great companies to also be overvalued. Now, not just that, those are some of the best large companies. Those are companies that are all part of the S&P 500. If we want to look at some smaller companies that aren't yet part of the S&P 500, that became very big before getting back to a small company again, take a look at this chart here. This is by Vincent Gallon, and what he points out is so many of these stocks, so many of these companies that seem like great companies, and maybe I shouldn't necessarily say great, but very popular, but their stocks have plummeted from their all-time highs. Take a look at this. Carvana, down 99% from its all-time high. Peloton, an extremely popular company, especially in the midst of the pandemic when everyone was doing their workouts at home. Well, it was down over 95% from its all-time high. You have Coinbase, you have Robinhood, you have Snap, you have Zoom. All these companies are successful companies. These are companies that are used by many, many people all over the world, yet their stock prices have done nothing but plummet. Why is that? Well, it's because people are making that mistake that I'm talking about here. People's only concern is this a good company or a popular company? And when that's all you look at, you're missing it. Because if we look at this, Peloton, still a popular company. Still a lot of people use it. Zoom, lots and lots of people are still using Zoom. Robinhood, very popular trading platform, still has one of the sleekest user experiences, but all these companies, their stock price has plummeted. So if all you're looking at is the popularity or how good the company is, you're making a mistake that too many investors fall into. Now let's look at an example of a company that did really well. Let's look at the 2010s. Now during the 2010s, it was all about Facebook and Amazon and Apple, wonderful companies that had really wonderful stock returns. Would you have guessed that Domino's Pizza, its stock price did better than all those companies? In fact, Domino's Pizza was the number 2 best performing stock during that decade, just behind Netflix at number 1. Now you look at that, you don't think of Domino's as the best run company. You don't think of Domino's as the most popular company even. But if we go back to that framework of it's not just about a good company, it's also about the right valuation. It's about what are you paying for that company. Domino's really turned things around at the beginning of the decade. And even though it's not a product that we maybe all use on a daily basis, it was a stock that did really well because of where you bought it, because of its valuation. Or Monster Beverage Corporation. Would you have guessed that that was the most successful stock from 2000 until today in the US market. For comparison, if you look at Amazon, which we all know has been a wonderful stock, if you look at Amazon starting in 2000 through the end of 2022, it more than doubled the return of the S&P 500. If you can double the return of the S&P 500 over a long time period like that, you're doing more than fine. You're doing really well when it comes to your investments. And if you had put in $100,000 into Amazon, that would have turned into $2,250,000 by the end of 2022. It's a pretty good experience until you compare that to investing in Monster. Monster Beverage Corporation, its stock did more than 50 times better than that. If you had put $100,000 into Monster stock at the same time, you would now have over $112 million in your portfolio. Now, when you look at Monster, do you think of it as the best company or the most popular company? No, we don't typically associate it with some of those bigger names that have been the high-flying stocks. However, it was the single best performing stock since 2000, and when all you're looking for is best companies or most popular companies, you tend to miss that. And in fact, if we look at it over time, you have growth companies, which are these companies like the Amazons and Facebooks and Netflix that until recently have done so well. And you have value companies, which tend to be thought of as more boring or more stable or more driven by fundamentals. But over time, value companies outperform growth by about 1% per year if you look back over the last 90 plus years or so. So how is it that better companies, growth companies, have worse performing stocks than value companies do? Well, it all comes down to valuation. When you pay too much for a company, your forward-looking returns aren't going to be as great. So that's the first mistake people make, is they think that a good stock is the same thing as a good company or popular company. The second mistake beginner investors make is they think it's all about timing the market. And how could you not think this? If you're new to investing, or even if you've been investing for a long time, it's hard to ignore that temptation of, geez, if I could just get out of the market when the market's going down and get back into the market when the market's going up, my returns would be so much better. Well, let's actually take a look at this. What if from 1965 to 1925, let's compare two different investors. One investor, every single year they invest, but they only invest on the day the market is at its high for the year. So they're incredibly unlucky or just bad investors. They put money into the market for 30 years, but they only do so at the very top of the market each year and then let that ride. Compare that to the other investor who they're either very good or very lucky. They only put money into the market during this 30-year time period on the very bottom of the market each and every year. Now, as you're thinking to yourself, how would you think those two investors compared? You've got to think that the one that timed the market perfectly, that only got in at the very bottom every single year, did way better than the other investor, right? Well, they certainly did, but maybe not to the extent you would have thought. The investor that got in the market only on the worst possible days every single year from 1965 to 1995, their annualized return was 11.7% over that 30-year time period. Now that's a tremendous return. But now let's compare them to the first investor who was either the worst or the unluckiest investor and only put money in at the very top of the market every single year. What do you think their return would have been? Well, it wasn't 11.7 like the other investor was, but it still was 10.6%. So when you look at that, maybe not the return difference you otherwise would have expected. Sure, there's a 1.1% difference, which over time, over 30 years, absolutely adds up. But those differences are relatively minor when you compare best possible scenario to worst possible scenario, the difference not being that significant. Why do I see beginner investors falling into this trap? Or more appropriately said, what's the implication of falling into that trap? Well, the implication is when people want to invest, they're waiting for the market to be low. They're waiting for that down day, which oftentimes leads to them staying in cash or staying conservative for far too long, and they never actually invest their money. Or they do invest it, but only much later. The implications of that are they're missing out on so many of those returns, whereas if they just put their money in, even if they put it in at the very top of the market every single year, they still had a wonderful experience over time. So beginner investors make this mistake, and even some experienced investors make this mistake of trying to time the market, of trying to get in at the bottom, where yes, if we knew exactly where that bottom was, we would do that 100% of the time. But we don't. The market's unpredictable. So it's more important to be in the market, time in the market, than it is to try to time the market. The third mistake I see beginner investors make is they set the wrong expectations. Now, this is to be expected. This is somewhat normal. And why is it normal? Well, when people talk about the stock market, they only talk about the returns. They say, hey, long-term, the S&P 500, it's averaged 10% per year. Or hey, if you've owned more value companies or small companies, over time you've grown by 11% or even 12% per year. So we hear that. And naturally, we set our expectations of that. We start to think, either consciously or subconsciously, I'm going to be getting maybe 10% per year if I invest in the stock market. Then the market drops like it did in 2022. Or then the market drops like it did in 2020 when COVID and shutdowns went into effect. Or then the market drops like it did in a major way in 2008, 2009. And if your expectation was that you should be getting 10% per year, and then not only are you underperforming that, but you're actually losing money for months and even years at a time, that's when people give up. That's when people quit. That's when people say there must be something wrong with my investments. They sell and then they miss out on the recovery. So we have to understand that fluctuation, uncertainty, bear markets, corrections, these are all a normal part of investing. You don't get 10% long-term in the stock market because you have some guarantee. If you want a guarantee or if you want stability, go to your bank. But you only might get 1, 2, 3% interest for doing so. The more growth you want, the more uncertainty you have to accept in an investment like the stock market. So when we look at the uncertainty, when we look at the downturn, we have to understand that's a feature of the market, not a bug of the market. That will always continue to be the case. There will always be fluctuations, always ups and downs, and the best way to set ourselves up for success is to have proper expectations. So what are proper expectations? Well, on average, the market's going to drop by about 10% once every year. Doesn't happen every year, and sometimes it happens more than once, but set yourself up with the expectation that if you invest money in the market, even if the market's up in a year, so even if the market's up, let's say 15% in a year, at some point in between January 1st and December 31st of that year, it likely pulled back 10% or more before continuing to grow. That should be expected. Once every 5 years or so, we're going to have a bear market. And bear market's just defined as the market dropping 20% or more. We saw this and then some in 2022. Now, if you're investing, expecting for your money just to be growing, or maybe you face a little bit of setbacks on a weekly or monthly or quarterly basis, but give it a year, give it 2 years, you think you're going to be fine, well, you're setting yourself up for failure. You have to expect that things will be volatile if you want to accomplish the long-term returns of the market. Now, if you hear that and say, well, James, I don't want 10% declines or 20% declines, God forbid a 30 or 40% decline, that's fine. But don't expect to achieve the long-term returns of the stock market. You can get a more consistent experience through more conservative investments, but recognize that there's a trade-off. The more security you want, the more stability you want, you can absolutely get that. It's very easy to get access to it, but you're going to limit the long-term returns you can expect. So the uncertainty and the volatility of the stock market, that's the price we pay for admission. That's the price we pay for tremendous long-term growth, but you have to have the right expectations. You have to understand that things will drop and that that's a normal part of the market. Now, you absolutely should be diversified. This isn't saying go buy the most volatile stock and hold on, but if you are diversified, you will still experience declines, but those declines will be temporary. Setting proper expectations around that is one of the keys to success. So those are the 3 mistakes I see beginner investors making. And by the way, if you're watching and haven't already done so, make sure to subscribe to this channel to get more updates on videos just like this. And if you're thinking, this is great, how can I learn more about investing, specifically investing to create a more secure retirement, be sure to check out this playlist here. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.